Hai, Assalamualaikum. My name is Nurin Akila binti Nazrul Azri. I am from ZBA 2492B. Today, I would like to tell you about CAPM. So, basically, what is CAPM? CAPM is Capital Asset Pricing Model. The Capital Asset Pricing Model CAPM describes the relationship between systematic risk and expected return for assets, particularly stocks. CAPM is widely used throughout finance for pricing risky securities and generating expected return for assets given the risk of those assets and cost of capital. So, to explain about CAPM, the Capital Asset Pricing Model was developed by the financial economist and later Nobel laureate in economics, William Sharpe set out his 1917 book Portfolio Theory and Capital Market. His model starts with the idea that individual investment contains two types of risk, which is the first one is systematic risk. So systematic risks are market risk. It is a general price of investing that cannot be diversified away. The example of the systematic risk is interest rates, recession, and wars. So the second one is unsystematic risk. Unsystematic risk, also known as specific risk. So this risk relates to individual stocks. In more technical term, it represents the component of a stock return that is not correlated with general market moves. So the example of unsystematic risk is business risk. So, modern portfolio theory shows that specific risk can be removed or at least mitigated through diversification of a portfolio. So the trouble is that diversification still does not solve the problem of systematic risk. Even a portfolio holding all the shares in the stock market cannot eliminate that risk. Therefore, when calculating a deserved return, systematic risk is what most plagues investors. So, to understand more about the capital asset pricing model, the formula for calculating the expected return of an asset given its risk is as in the slide. So, investor want to be compensated to the risk they take and the time value of their money. The time value of their money is represented by the risk-free rate in the CAPM calculation. So the CAPM formula other components take into account the investor willingness to take on more risk. So the beta of a potential investment is a measure of how much the risk of the investment will add to a portfolio that looks like the market. If a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta of less than 1, the formula assumes it will reduce the risk of a portfolio. So, a stock beta is then multiplied by the market risk premium, which is the return expected from the market above the risk-free rate. So, the risk-free rate is then added to the product of the stock beta and the market risk premium. So, the result should give an investor the required return or discount rate they can use to find value of an asset. So, what is the goal of CAPM formula? The goal of CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of a money are compared to its expected return. So next, we go for beta role in CAPM. So according to CAPM, beta is the only relevant measures of a stock risk. It measures a stock relative volatility. It shows how much the price of a particular stock jumps up and down compared with how much the entire stock market jumps up and down. So beta is found by statistical analysis of individual daily share price return in comparison with the market daily returns over precisely the same period. So what the beta calculation shows is that a riskier investment should earn a premium over the risk-free rate. So the amount of the risk-free rate is calculated by the equity market premium multiplied by its beta. So next, what CAPM means for investor. So this model presents a simple theory that delivers a simple result, which is the theory says that the only reason an investor should earn more on average by investing in one stock rather than another is that one stock is riskier. So not surprisingly, the model has come to dominate modern financial theory, but does it really work? So first one is the model is widely used in the investment community. So although it is difficult to predict from beta how individual stocks might react to particular movement, investor can probably safely deduce that a portfolio of high beta stocks will move more than the market in either direction. So and a portfolio of low beta stocks will move less than the market. So CAPM also contributed to the rise in the use of indexing. So assembling a portfolio of shares to mimic a particular market or asset class by risk-averse investor. This is largely due to CAPM message that it's only possible to earn higher return than those of the market as a whole by taking on higher risk, which is beta. Why CAPM is important? So the CAPM formula is widely used in the finance industry. It is vital in calculating weighted average cost of capital, as CAPM computes the cost of equity. So weighted average cost of capital is used extensively in financial modeling. It can be used to find the net present value of the future cash flows of an investment and to further calculate its enterprise value and finally its equity value. So the problem with CAPM. So the first one, the securities market are very competitive and efficient, which is the relevant information about the companies is quickly and universally distributed and absorbed. So the second one is these markets are dominated by rational, risk-averse investors who seek to maximize satisfaction from returns on their investment. So, the advantages and disadvantages of CAPM. The advantages of CAPM model. There are numerous advantages to the application of CAPM, including ease of use. So, the CAPM is a simple calculation that can be easily stress tested to derive a range of possible outcomes to provide confidence around the required rates of returns. Next, diversified portfolio. So the assumption that investors hold a diversified portfolio similar to the market portfolio eliminates unsystematic risk. Systematic risk. The CAPM takes into account systematic risk which is left out of other return models such as the dividend discount model. So the systematic or market risk is an important variable because it is unforeseen and for that reason often cannot be completely mitigated. So the last advantages is business and financial risk variability. So when businesses investigate opportunities, if the business mix and financing differ from the current business, the other required return calculations like the weighted average cost of capital cannot be used. However, the CAPM can. Next one is disadvantages of the CAPM model. The first one is risk-free rate. The commonly accepted rate used as the RF in the yield on short-term government securities. Second one is the return on the market. So the return on the market can be described as the sum of the capital gains and dividends for the market. The third one is ability to borrow at a risk-free rate. The fourth one is the termination of project proxy beta, and the last one is the enter the world of forex trading. So that's all from me, and thank you. Hope you can enjoy it.